All right, really, this talk is not actually intended to be about cryptocurrencies. It's about beyond cryptocurrencies. What if you want to use blockchain for real-world assets? And like Dan, I have this problem that most of what I work on at Stanford is my students' very excellent ideas, including the next talk that you'll see. So it doesn't really make sense for me to talk about my students' ideas. But currently I'm on leave, and so I'm going to tell you about something that I'm doing not at Stanford, but then Stanford requires this obligatory disclaimer here. All right. So let's say that you wanted to send $1 from here in the United States to a friend of yours in India. All right? So if you tried to do this with today's banking system, you'd find that it probably takes like the better part of a week to do this, that to send your $1, you'd probably be spending $20 in fees. It's likely that your friend in India would probably be paying more than $1 in fees to receive this international wire. And in fact, this scenario is preposterous, right? Like nobody would actually send $1 to India because this is just like completely clunky and ridiculous today. So in an ideal world, this would be completely simple, as easy as sending email, right? You would just stick $1 into your computer, and it would pop up in India, or maybe your friend could get 60 rupees or something out of some bank in India, and it should be as easy as sending email. So the obvious question, is this a job for blockchain, right? One of these magical Satoshis has come down and given us this amazing gift of blockchain. Should we be able to use this to send $1 to India? Well, before we answer that question, there's just so much hype around blockchain that I think we should cut through it and talk about what does blockchain actually give us. And really, it kind of boils down to three things. So the first thing that we get out of blockchain is coin distribution. How do you invent some new coin out of thin air, like BitCoin or any of these other coins, distribute it to people in such a way that there's a limited supply of the coin, but people still believe it has value? And that's something that in 2008 seemed kind of impossible. And yet we've solved that problem, and boy, does it generate a lot of headlines, right? Because you have all these people who bought some asset for like pennies, and then it became worth $20,000 or close to it a few months ago. Yeah, so that gets a lot of attention. The second thing, though, is I think the even more interesting aspect of blockchain, and that is that what blockchain gives you is it gives you irreversible transactions even with parties you don't necessarily know or trust, right? So that's what allows me to walk up to you like we've never met before. We don't trust one another. I can give you some digital coin, and you can give me some physical real-world asset that I can walk away with because you're confident that that digital transaction is not going to be reversed. And then kind of the third benefit that we get out of blockchain are kind of a whole set of purely incidental benefits that didn't really require any scientific breakthroughs, right? So this would be, for example, like blockchain works 24/7, unlike the stock market that only works during certain hours. Or credit card numbers are terrible. They're just numbers. They'd be better if they were public keys, but and blockchain gives you like public keys naming your accounts, which is kind of convenient. Probably the one that has also gotten the most attention is the regulatory differences that you get from blockchain. Because it kind of breaks all the rules, it creates a lot of regulatory uncertainty, and so it's kind of allowed people to innovate sort of Airbnb or Uber style in areas that were probably over-regulated, but regulated for a reason. And so what we really need in the long term is, of course, to harmonize regulation across blockchain and non-blockchain kind of things. So I think numbers 1 and 3 have really gotten all the attention, but the super interesting one is number 2, and I'll get to why a little bit later on. So okay, so why do we have blockchain? Well, because of this paper on Bitcoin a few years ago that basically had this insight that we can solve problem number 1 and problem number 2 at the same time in a mutually reinforcing way using this technique called mining. Okay, so what is mining? Well, mining is basically obtaining new cryptocurrency as a reward for making other people's digital transactions harder to reverse. And the mining technique that's most popular these days is called proof of work. And that's obviously the one that Bitcoin uses and Ethereum. And the idea is you solve this kind of hard search problem that's a function of the entire history of transactions plus a new batch of transactions you want to commit. And it's very hard to solve that search problem, but once you've found a solution, it's very easy for everyone to verify it. So you sort of put a whole bunch of work into searching for a blockchain that solves these constraints. And if you wanted to reverse transactions, you'd have to do as much work as all the good guys have done to create an alternate blockchain. But those guys got rewarded, and maybe you won't get rewarded, so you won't be incentivized to do that. There's other forms of mining, like instead of computation, there's proof of storage and proof of memory. And then there's also proof of stake, where in one way or another, you kind of use your coins to people. Your clout depends on how many coins you have, and that you use that to influence what the next set of transactions will be. But they all basically boil down to mining. OK, so as I said, I think the most interesting thing about blockchain is these irreversible transactions. And where that gets even more interesting is when you have multiple kinds of token on the same blockchain and you can trade between them, right? So let's come back to this example where I wanted to send $1 to my friend in India. Maybe I'm at the US in Bank 1, my friend's at Bank 4 here in India. And maybe Bank 4 has a bank account at another bank, Bank 3 in Europe. These are called Nostro accounts when a bank has an account at another bank. And Bank 4 might say, hey, if you add 93 euro cents to my account at Bank 3, I'll give whoever you want 60 rupees at my branch in India. Maybe there's some other bank, Bank 2, that has accounts at both Bank 1 and Bank 3, and Bank 2 says, hey, I'll trade you, if you give me $1 to my account at Bank 1, I'll give you, 93 euro cents at Bank 3. And so what you could do is, with a blockchain, you could pack this all together into an atomic transaction and execute this transaction and actually change your dollar into rupees without trusting any of the intermediary parties like Bank 2, right? And so in order to make this work, what you need is for banks to issue tokens that represent claims on deposits, like in dollars, euros, and rupees, and then the ability to execute these irreversible atomic transactions. So this is a very compelling example, but there's something interesting here, which is that I haven't used cryptocurrency at all. Notice that there's no Bitcoin or Ethereum or anything in this picture, right? These are just currency-backed tokens that have been issued by these regulated counterparties, right? Because they're banks, and we trust our banks to be solvent because we have a whole bunch of infrastructure around making sure that our banks are solvent and responsible. OK, so currency is one of many examples of useful tokens issued by known counterparties that might be useful to trade on a blockchain. So another would be, say, like Kickstarter-style rewards, right? I go to Kickstarter, I spend $500 to fund some, special foldable canoe, right? And that entitles me in a year to get one of these foldable canoes if the project is successful. So that's effectively a future for this product that's going to come out. Wouldn't it be great if there were a secondary market for the future? And if in 3 months I decide I don't want the canoe anymore, I could sell that future to somebody else, right? Well, you could do that if the asset that you got in exchange for investing in this canoe project was on a blockchain that contained other assets like dollars, and you could trade for those assets. Other examples would be like certificates of authenticity for art or safety-critical parts, any kind of securities like stocks, bonds, mutual funds. Obviously, we're used to tokens for transit rides, cell phone minutes. There's a famous kind of economics paper on babysitting script and what goes wrong if you don't have enough supply of it. But that obviously you could do on this. Prediction markets, whatever you can think of. The fact is that if you can issue these assets on a blockchain, if you can kind of tokenize them and issue on a blockchain, and the blockchain gives you irreversible transactions, then kind of for free you get a secondary market in any kind of asset that you issue. OK, so what's the problem? Well, the problem is that blockchains can fork. So in July of 2016, Ethereum, which is like the second biggest blockchain, executed this weird kind of irregular state change that was just kind of hard-coded into the thing. Now, what happened? Well, basically, what happened was that there'd been this contract called the DAO, and there was a bug in the DAO. And because of that DAO, people lost $50 million, which at the time was a lot in the blockchain space, right? And so basically, everybody said, oh, this sucks. We wish this bug hadn't been there. If only we could go back in time and fix this bug. And so 85% of the miners said basically, OK, here's what we'll do. We'll just kind of change the rules and make up this special one-time rule to basically bail out this DAO contract and reverse the effects of this unfortunate bug. And so 85% of the Ethereum miners decided to go ahead with this weird change and execute it. The other 15% said, hey, wait a second, the rules are the rules. Like, it sucks that there was this bug, but like, people aren't going to trust this as they feel we're going to make up the rules as we go along. So we're going to keep going under the original set of rules. And that branch of the blockchain became Ethereum Classic. More recently, there was a dispute in the Bitcoin space where there's one set of people who wanted to basically do this thing called segregated witness, which was probably a good idea objectively, although there were some issues in how they did it. There was another set of people who said, what we really want is more transactions per second, so we need to make the block size bigger. Also, they were probably motivated by the fact that SegWit defeated some mining optimization that some people were using. So what you had was Bitcoin on one hand, and then this kind of fork that shared a same prefix of the history as Bitcoin called Bitcoin Cash. And if you think that's kind of a dumb idea and you don't like Bitcoin Cash, or maybe you don't like Bitcoin, if you had a Bitcoin before, now you have one Bitcoin plus one Bitcoin Cash. So you could turn around and sell your Bitcoin Cash for $600, say today, and who are you to complain? You just got a free $600, right? It's kind of like if you had a company and the company spun off a subsidiary and you got stock in the parent company and the subsidiary, you could sell either one of the two. But the problem is, what would this mean for token issuers, right? Suppose that you're a bank and you issue dollars onto the Ethereum network in, say, like June of 2016. Well, now you potentially face twice as many redemption requests, right? Because you've got the same number of dollars on the Ethereum and the Ethereum Classic blockchain, right? And this is clearly very bad, right? You don't want to face liabilities for twice as many digital dollars as you've issued. So the moral of the story here is that mining is actually pretty scary for digital asset issuers, right? I mean, first of all, mining is anonymous, right? All it means is that somebody with sufficient resources has, executed the computation to extend or fork the history. And so far we've been kind of lucky with the high-profile forks have been kind of announced in advance, and each has been assigned a separate name, like Ethereum and Ethereum Classic. But you could imagine, a branch where it's just like a fork where it's like two different, competing pools of miners who are kind of duking it out and saying, hey, everybody join our mining pool because then we'll give you more rewards. And if this goes on for a while and they're both playing under the same rules and the mining is anonymous, you can't even name the two different forks. So how are you going to say like who's allowed to redeem your tokens that you've issued and who isn't? Another problem is that the mining rewards themselves might actually provide insufficient incentive for securing your transactions. So even on the biggest blockchains like Bitcoin and Ethereum, the mining rewards today are under $10 million a day, which is dwarfed by the number of the amount of sort of dollars, that it's like trillions of dollars moving between banks on a daily basis, right? And what's kind of worse is that now there's like Bitcoin futures you can trade. So if you're a miner and you're about to do something really weird, you can actually hedge yourself against the damage you're going to do to Bitcoin by selling a bunch of Bitcoin futures, right? And then you can kind of wreak all kinds of havoc. And the other thing is there might be non-financial kind of extrinsic incentives to do this, right? Let's say you're a forward-looking company and you say, hey, I'm going to issue my stock on Bitcoin by using colored coins to represent my shares, and now my stock can be traded on blockchain. And then you do some high-profile deal with Taiwan, and next thing you know, like weird things are happening to your stock sales. They're getting reversed and whatever. And well, nobody's come out and threatened you, but you know that there are a lot of miners in China, and like this is just would be a very uncomfortable situation to be in. Okay. So the moral of the story here is we have to protect asset issuers from forks in the blockchain. And so the obvious idea here is, why don't you require whoever's issuing an asset to endorse all the transactions in that asset, right? After all, the issuer is a counterparty to these digital tokens, so they should be allowed to know who's transferring the money and make sure that it's not that the coins aren't getting duplicated. So you could kind of call this the PayPal model, right? You've got this centrally managed ledger like PayPal, keeping track of who has all these tokens. And obviously, PayPal doesn't face the threat of double claims on redemption because everything happens through them. But if we went to a world with kind of 1,000 PayPals, for, you have a PayPal for your transit rides, a PayPal for your cell phone minutes, a PayPal for each of these things. The problem is that you then can't trade across these different PayPals, right? So this rules out even basic Forex trading. And I would argue that most of the most compelling applications of blockchain involve introducing new token types and being able to have atomic transactions that involve multiple different token types. So the idea that we had with Stellar, which is this nonprofit I'm involved with, is what if we have many issuers issuing tokens, but all on one ledger? However, each issuer is going to define tokens in such a way as to prevent double claims. And so what we're going to do is we're going to have the issuers, each issuer is going to designate a validator authority who's kind of authoritative for one portion of the ledger, namely the holdings in that issuer's tokens, right? And then all the different validators are going to cooperate to maintain this single global ledger. But if history did fork, there'd be no ambiguity as to which version of a ledger was authoritative for which token type, because you've kind of declared that in advance. And these validators, they're known parties. They're not anonymous at all. They're things like banks or big companies like IBM, for example. So the idea here is that, well, we already trust the token issuers to remain solvent and to be willing to redeem tokens, because that's what gives the tokens value. So why don't we also trust the token issuers to make the transactions irreversible? And in order to do this, we need to make, so kind of the idea here would be that imagine that you're only going to agree that a transaction happens when all the sort of counterparties you care about do. So if you're interested in cashing out dollars at bank 1 and rupees at bank 4, then you'll say like, hey, I'm only going to agree to a transaction when my bank in San Francisco and this other bank here in Mumbai, India, have both agreed that this has happened. But these banks deal with other banks, right? And so they're not going to agree that a transaction has happened until the banks that they depend on agree it's happened, who also will depend on other banks, and so on, until you kind of take the transitive closure of these dependency relations, and eventually the whole world has agreed that this transaction has happened. And so at this point, once everybody's agreed, it becomes very hard to roll this back. And even if you remember in the example, I had Bank 2, we didn't know who it was, but it was offering us a good rate getting from dollars to euros. And so if Bank 2 somehow decides the transaction didn't happen, but the whole rest of the world does, well, who cares? Because at the end of the day, you don't care about cashing anything in at Bank 2. And so Bank 2 could just be in its own weird little fork of the world. Or if it wants to exist and continue to exist in the banking system, it'll have to agree that this has happened. So in order to make this happen, we need one assumption. And this is something that I call the internet hypothesis, right? So the internet is this globally connected network. But what's interesting is that there's no central authority that's dictating the structure of the internet, right? Instead, basically, the internet has arisen out of these pairwise relationships between networks that enter into peering and transit agreements, right? And so, of course, this decentralized peering structure could have resulted in multiple different internets, but it didn't, right? It resulted in this one network that we call the internet. And the reason is that sort of transitively, everybody wants to talk to everyone, right? Like, I may not know who you are, but I want to talk to, say, Google, you want to talk to Google, or I want to talk to somebody who wants to talk to Google, and so on. If you take sort of the transitive convergence of everybody people want to talk to, you'll get kind of a lot of overlap. So the hypothesis here is that counterparty relationships in these tokens are actually have the same kind of transitive convergence, right? So you have banks dealing with correspondent banks, dealing with clearinghouses, and essentially these clearinghouses are going to be like the tier 1 ISPs of payments. So using this idea, we can define a new kind of consensus protocol that I call Federated Byzantine Agreement. And the idea is based on Byzantine agreement, which is a known technique for achieving consensus amongst a closed group of nodes. But the problem with classic Byzantine agreement is that it bases security on this notion of majorities, right, or supermajorities, right? So it's vulnerable to this attack called the Sybil attack, where you say, hey, any like 2/3 plus 1 of nodes constitute a quorum, and so a bad guy comes in and creates 100 fake nodes that it all controls, and so it overwhelms the number of good nodes. So the idea is we're going to defeat these Sybil attacks by choosing quorum composition in a decentralized way, and this will be much less symmetric, but it'll depend on the actual trust that people place in the entities in the system. So the way this works, each node V is going to pick one or more sets of nodes that we call quorum slices. And V basically picks as a quorum slice any set of nodes that it considers important enough to kind of speak for the network as a whole. Right? So the choice is going to be based on real-world identities, but in particular, if you care about redeeming tokens issued by particular nodes, you probably want to put those nodes in all of your quorum slices. So given this idea, we can define a federated Byzantine agreement system as a set of nodes V and this quorum function Q, where Q of little v is the set of slices chosen by node V. And now we can define a quorum to be a set of nodes U that contains at least one quorum slice of each of its members. So here's kind of a simple example. I'll have 4 nodes. Each one has a single quorum slice. And I'll visualize the quorum slices by drawing an arrow from a node to the other members of its quorum slice. Right? And you can see that V1 has quorum slice V1, V2, V3. The other nodes have quorum slice V2, V3, V4. So if we consider V2, V3, V4, this is trivially a quorum, because it is every one of its members' quorum slices. What about V1, V2, V3? That's a quorum slice. It's not a quorum because V1 is saying, I'll agree to anything that V2 and V3 do, but V2 and V3 say, we'll only agree to something if V4 does. So the smallest quorum, including V1, is actually the set of all nodes in this example. So here's a little more realistic example. Have a kind of tiered quorum slice structure reminiscent of the internet, where maybe there's a top tier of quorum of validators that depend on 3 out of 4 each other, and then maybe a middle tier that depend on 2 out of 4 of the top tier, maybe there's a leaf tier. But like the internet, there's going to be no central authority appointing the tier 1 validators. Instead, it'll be left to market choices, and maybe the market decides, hey, the top 4 retail banks, these are what should constitute the top tier validators. But you don't need complete consensus on this. So V7 and V8 might be paranoid, and they might say, well, we realize we have to deal with the big banks, but we don't trust them. We also want to depend on some nonprofits whose incentives are differently aligned. So they'll say, we'll wait for 2 out of 4 big banks to sign off on our transactions, but also 1 out of these 3 nonprofits. And the nonprofits depend on 2 out of 3 of each other. OK, so let's say that this paranoia is well-founded, and Citibank walks up to V7, pays V7 $1 billion, and says, hey, V7, I just gave you $1 billion. We've got this blockchain magic, so you know it's irreversible. Give me $1 billion worth of goods. I'm going to walk away with them, and you should feel secure that you got your payment. Right? And so V7 says, OK, I need 2 out of these 4 big banks. Got that. I need 1 of these nonprofits. Got that. This nonprofit needs another nonprofit. Got that. These guys need 3 out of 4. Got that. Good. Everything is good. Now it turns out the paranoia was correct, and these big banks are evil, so they collude to kind of reverse the effects of this transaction. And then they walk up to V8 and say, hey, V8, here's $1 billion that we shouldn't have because we gave it to V8, but it sure looks like we still have it. So why don't you give us $1 billion worth of goods? We'll quickly run away with that. Right? And V8 says, well, I need 2 out of 4 big banks. Check. I also need 1 of these nonprofits. Well, Stellar and EFF aren't going to sign off on this, right? Because they know that the money now belongs to V7. But maybe ACLU was kind of lagging behind. So V8 talks to the ACLU. But the ACLU depends on 2 out of these 3 nonprofits. So ACLU say, well, sorry, I'm not going to believe this unless one of these other nonprofits signs off. And that's not going to happen because the other nonprofits know this isn't legitimate. So those nodes will basically protect V8 against this double spend attack. OK, so basically, I designed this consensus protocol based on this idea. And it has some nice properties, basically it guarantees safety when you have quorum intersection after removing all the nodes that deviate from the protocol. And that's a necessary property for safety in this kind of model. So what I've shown is also sufficient, meaning that basically SCP kind of provides optimal safety. So you might regret your choice of quorum slices, but you won't regret choosing SCP over some other consensus protocol. It also guarantees that a well-behaved quorum won't get stuck. The core idea in the protocol is this idea of federated voting, right? Nodes exchange these vote messages, but each vote specifies the voter's quorum slices. And so as you collect votes, you can kind of dynamically discover whether or not a set of nodes constitutes a quorum. So the way this works is there's kind of 2 phases to the protocol. In the first phase, you have nodes nominating values until at least one value until they've agreed on nomination of at least one value. So here, maybe let's say they've agreed that TX3 is nominated. And then they kind of continue to propagate values until they converge and ultimately they will converge on some set of nominated values, which they can combine in some deterministic way. And you can actually show that they're guaranteed that all nodes will eventually converge on the same set of nominated values. Now, there's a catch here because of this impossibility result in distributed systems for consensus, that they will never know, even though you're guaranteed to converge, you never know that you have converged. So you take your best guess that the system's converged, and then you move on to the second phase called balloting, which is similar to Byzantine Paxos, if you know Paxos, but it uses federated voting, right? So basically you prepare a ballot and you commit a ballot, and if everybody's converged in the first round, this will be fast and easy, and if not, well, it'll be a little bit slower, but it'll still be guaranteed to be safe and it won't get stuck, so as long as the network behaves, eventually you'll confirm some value. Okay, so this algorithm, this SCP, is in production use by this blockchain called Stellar. It's like the 8th largest blockchain today. And we've got, actually, we have last night when I was preparing these slides, we had 106 validators participating in consensus. This morning I happened to check again on the way, and it's actually up to 108. So I guess the system is growing, and they're achieving consensus every 5 seconds. And it's not expensive to participate. You just need to compute a few digital signatures every 5 seconds. So we can, it's much cheaper to participate in the system. It's an open network and anyone can join, but of course, merely joining doesn't mean that you're going to end up in other people's quorum slices, right? That happens when people know, based on your reputation, that they should depend on you, or that they want to depend on you. So we've seen all kinds of people participate, like there's big companies like IBM, we have telephone companies, money transmittal organizations, universities. So there's a bunch of different types of validators in there. And our primary use case today is for international payments to make this much cheaper and faster, but we've seen all kinds of other uses kind of emerge. So for example, it's being used by coffee futures, by this company called Bex360, in-app currencies, geological data, cryptocurrency baskets. Basically, you name it. If you want to issue a token and you want there instantly to be a secondary market for that token, Stellar's a good platform for that. So compared to other approaches, you could try to use Byzantine agreement over a closed server set and say, well, these are the big banks, these are the people who should participate. If that actually happened, what you'd probably end up having happen is that a bunch of kind of third parties would come and be like auditing the performance of these big banks to keep them honest. And so basically you kind of get a poor man's FBA anyway, so you might as well kind of do it right and get optimal safety from the thing. And of course, you might also be tempted to use to proof of work, but again, then your consensus is intricately tied up with coin distribution and these incentives. And if you're not interested in generating new coins, but you want to just issue tokens back to a real-world value, that's not necessarily the best thing. In fact, the incentives might prove insufficient or ill-suited for the assets that you're issuing. All right, thanks.
We have time for questions? Actually, I'm really curious. So you have 108 validators?
Yeah.
So what do the quorum slices look like in the real world? What do people actually choose as validators?
Yeah, I think what people choose is a much smaller subset of those. I think of those 108, there's probably at most 30 that people actually depend on.
Are those banks and nonprofits? Or
like I said, it's all over the place. So IBM has 5 of them or something, and all around the world. Stellar obviously has like 3 of them because we're the people putting this out. But yeah, then there's like a telco. There's, you can go to what is it, Stellar? I have it linked in the slides. There's like various websites that list these. So like Talindas does one. That's a telco. There's like Tempo is like issues these euro-backed tokens. They're a money transmittal organization. There's I'm not sure. It's all kinds of people basically.
wow. Yeah. Any other?
Do you have any model for what might be the effect of bribes?
Of the effect of?
Bribing one organization trying to bribe another to collude.
Yeah, I think this is a big problem with the proof of work stuff. It's not an issue in Stellar because you know, as an issuer, you're protected. I mean, you're the one issuing the tokens, so you know, basically you could.
Stand over there.
Well, I'm just going to remove my laptop. So yeah, so if you're concerned about bribes, then you definitely would want to use something like Stellar and run a validator yourself, such that you could guarantee that no funny transactions go through that you don't approve and nothing gets rolled back.
Hi.
Any other?
Hi. So you said 108 nodes, right? So those nodes getting any?
Sorry, where? Oh.
So nodes are getting any benefits like token or anything by joining it?
No, it's more like, why do you run a mail server instead of telling all of your employees to use Gmail or something? Because it's not that expensive, and you want some control. It's convenient to like have control over it. So, it's not, mining Bitcoin is hugely expensive, right? Running a Stellar validator, yeah, you need like a computer and a few gigs of memory or whatever, but it's not particularly onerous, right? You do it for the control.
Mainly proof of work as a node than anything else.
No, there is no proof of work. You are digitally signing a message saying like, yes, I agree that this is the next batch of transactions. So it's very cheap to run a validator. And what you get is the ability to protect yourself against double spends, because you tell people you're dealing with, hey, the transaction hasn't gone through until my validator has signed off on it. And my validator won't sign off until all the people I consider important have signed off on it.
But you could.
But let's say
you could charge a service fee if you wanted to, as a validator. You do not make money as a validator. There's a small transaction fee for just anti-spam reasons, but that goes into like an inflation pool. We do not reward validators any more than we don't reward mail servers, right? Like you run a mail server because it's convenient for you to have email and because it's not that expensive. You don't run it because you get mining rewards or anything. So that's our model, and that's proving to work out, right? Because a lot of people, they want a copy of the ledger state anyway, so they might as well run a validator, or they're issuing a token and they want to protect themselves against double spend attacks.
Example, I build a data distributor application on top of Stellar. So my algorithm says that I distribute 30% of the data across the validator, 108 nodes. They are storing my data, but they're not getting anything. So you have any restrictions on Stellar, like you can?
Yeah, so there's a native currency, which is sort of counterparty free, and there's a minimum balance in an account in that currency, and that minimum balance is proportional to how much ledger state you're taking up. Unlike a UTXO-based blockchain like Bitcoin, we can truncate history. You don't have to keep the whole history. So you can actually reduce the amount of state and get back your minimum balance. But basically, like, it boils down to, yes, there's anti-spam protections to make it expensive to consume a huge amount of state in the ledger.
Thank you.
Cool. Thanks, David. Yeah.